subtract the principal minus, we subtract the loan size minus the principal to get the balance, and we move the balance back to the loan size, and then again we subtract the loan size minus the principal to get the balance, and then we move the balance to the loan size, and then the loan size minus the principal to get the final balance. So we repeat this process for all the 5 payments. We subtract the loan size minus the principal to get the balance. Then the balance becomes the next loan size for the next period, and we do the same. So now we're going to calculate the interest. So for this case, the reducing balance method, we keep calculating the interest continuously. So 10% of the loan size, so 10% of 50 million is 5 million. We're going to fill in the interest through that column. We're going to keep calculating it. So we then have 10% of 40 million, which is 4 million. And then we're going to have 10% of 30 million, which is 3 million. And then we shall have 10% of 20 million, which is 2 million. And then 10% of 10 million, which is 1 million. And then we are going to move and obtain the total as 15 million. So the interest we are paying back in total is 15 million. So we move on to the book value. The book value is the total. We're going to add the principal plus the interest to give us the book value. So we're going to have 15 million at the top, 14 million next, 13 million there, 12 million in the next, and then finally 11 million. So when you add this, you'll get 65 million. So this is how you work out a loan repayment schedule using the reducing balance method. So we are going to move on to using the fixed installments method. So as you can see in the reducing balance method, we find the total of the principal, the interest, and the book value down there. So we're going to use the second method for working out loan repayment schedule, the fixed installments method. As we said, we write the title, we first write the company name, then we write loan repayment schedule for the amount of 50 million Ugandan shillings. Attracting an interest of 10% payable in 5 equal installments. Using the fixed installments method. Well, the fixed installments method, we say that here the interest is calculated once and it is constant throughout till the end of the payment of the loan. So this is also the simplest way of calculating a loan repayment schedule, but it depends on the question on what they have asked you to prepare. So they may ask you to prepare using the reducing balance method or the fixed installments method. It depends on the examiner. So right now I am preparing for you both so that you can understand and learn how to apply any in case they ask you for any of them. So we're going to write our titles, duration, loan size, principal, interest, book value, all in shillings, and then the balance also in shillings. So our loan is 50 million and our installments are 5, so we put them there, 5 of them. So we're going to repeat what we did in the first part of the question. Put the loan size, the principal, the loan size as our 50 millions, the principal as our 10 millions throughout, so that we can show that we shall ensure that by the end of the payment of the loan, it's all totaling to 50 million. The bank gets back its 50 million. So we come and calculate the balance. So 50 million minus 10 million, again 40 million, and then 40 million moves to the part of loan size. So 40 million minus 10 million gives you 30 million. 30 million moves to the part of loan size. 30 million minus 10 million gives you 20 million, and then you repeat the process till when you get 0 in the bottom right corner. So ensure that this is done for all the durations. So we're going to calculate the interest. The interest is 10% of the loan size. The loan size is 50 millions. So we're going to have 10% of 50 millions, which we got last time as 5 million. So we are just going to fill in 5 millions from the top to the bottom. That is how the fixed installments method works. It just puts the interest in a constant form, in a constant manner. The interest will not change, it will stay constant. It's easy to prepare but costly to pay. So as we said, book value is got by adding the principal plus the interest. So 10 million plus 5 million gives you 15 millions. So book value throughout should be 15 millions. Plus don't forget to find the sum down of the principal, the interest, and the book value. You add them at the end. Do not forget that it is very crucial. So that is how you work out a loan repayment schedule using the reducing balance method and then the fixed installments method. This topic is pretty easy. It just needs a little bit of practice. Of course, practice makes perfect. So keep practicing this topic and I'm sure you'll never fail a number like this again. So once again, thank you for watching. Thank you for staying this long. So thank you for watching. If you like this video, please subscribe, like, and leave a comment, and hit that notification bell so we can notify you when we new videos.